I'm Mark Draper from Gem Capital. Today we're talking with Roland Wynne from Hunter Hall, Global Investment Manager, and we're talking about investing in a low growth environment. So Roland, it's well accepted that economic growth is likely to be low for the foreseeable future, particularly in the Western world. So how do share market investors make money in a low growth environment?
Yeah, Mark, I think in a low growth environment it's obviously harder to make money. If you go back to pre-GFC, all stocks moved up with the tide, and now we're in a market where it takes much more discipline, and it's a real stock pickers market. Having said that, I think there are always opportunities even in a low growth market, and you could look at that across time in different markets, in bear markets, in previous cycles where people have been able to make money. A couple of good examples for us, both in income stocks and for us deep value stocks, where essentially if you've got a part of the economy that's growing, say for the tech sector, or where someone's invented something new, those stocks are still going to be fundamentally increasing in value and generating wealth for their shareholders, essentially. A good example is if you look around your living room and look at the items in your living room or in your car or in your purse that weren't there 5 years ago, and think about the share of the wallet that's gone to that. So your iPhone, the iPods back in 2002, tablets, changing over from your notebook to a tablet, all of that expenditure didn't exist in the last decade, and we're only seeing a fraction of that come into play today. So for us, I think even in a low growth environment, if you can find companies that are fundamentally creating something that people want, then you're going to make money. And that's on new sectors. The other one's obviously for what you would call classic deep value stocks as well, where even in a business that's been significantly beaten up, you've got the opportunity to make money. A good example I'll give you is we had two investments in hard drive makers, Seagate and Western Digital. 20 years ago there were 200 hard drive makers around. Now there are only two. So that's a massive consolidation of the industry, and people have said, look, this industry's dead because people aren't buying desktops anymore. They're all going to store their information in the cloud. But if you look around again, think about how much video you record on your hard drive, how many photos you take. All of that is in a digital medium. It needs to be stored somewhere. So when people say they're going to store it in the cloud, that's fine. They're not storing it on their computers. They might not even store it on a desktop hard drive, but they're going to have to store information somewhere, and that's going to benefit those two people that are now effectively in a duopoly.
Yes.
And they're going to be able to make a much more rational return. So that's a classic example where even in an industry that's had massive headwinds, in a down market, you're able to make money.
Okay. And so what do you see as the potential bright spot sectors that might be available for investors right now?
Yeah, so I guess two things. I'll lead with the example that I've just worked on. So a bright spot right now is obviously tech. So if I look in North America, and particularly the US, that's a pretty tight, sick economy, but there's a portion of that that's always creating something new, obviously the tech sector.
Yep.
So there's big opportunities in that sector to both make money and lose money, as we've seen in the last decade.
Yep.
And so it's important that you pick the right companies that are actually able to extract the proper share of the wallet. A good company that we own is called InterDigital. InterDigital, it's not well known, but it allows for communication between your mobile phone and the base towers, and essentially these guys have a patent over really what's a mathematical algorithm, and out of that they charge a toll to all their customers that use 3G and 4G phones. So chances are, if you've got a 3G phone, a portion of that price that you paid went to this company called InterDigital. So if you can imagine, all phones that are going to be sold in the future, as we increasingly move from what you would call the old style feature phones to a smartphone, this company picks up a toll on that. So it's a fantastic company to get. So if you can find companies where both they're creating something new, they're part of a new market, plus they're effectively tolling your consumption of that, it's incredibly valuable.
Yeah.
But as I said, there's obviously pitfalls. As we speak, Groupon is an interesting company that people are looking at. It's trading above its IPO price, but the level of short interest in that, so the people that are effectively bears on that stock, is increasing by the day.
Yeah.
So again, you have to be careful of jumping on the latest bandwagon and make sure that you're paying a reasonable price for something that's going to take a fair share of people's wallets going into the future.
Yeah, and I know you're keen on the tech sector. So how do you separate the potential winners from the potential losers in that sector, Roland?
Yeah, I think the tech sector's not different from any other sector in terms of the investment disciplines we have to apply. So from a deep value perspective, you have to be aware of how something is trading relative to its book value, how it can earn a return above its cost of capital, and that'll give you an idea of whether it should trade above its book value. And again, classic multiples. So is it trading at a fair multiple to its current and future earnings? And is it trading at a fair multiple on both its enterprise value? A lot of these companies have large portions of cash on their balance sheet, and others are fairly levered up. So we have to be disciplined, like we are in any sector, in that regard. The second part of that is making sure that you've picked up something that's going to have a product with a bit of longevity. So making sure that there's a terminal value at the end of whatever cycle that you're looking at. So again, as I said, with say the hard drive makers, where people have written them off and said there's no terminal value. The reality is these things have a value because you're going to store your information somewhere.
Yeah.
So the tech sector, there's lots of opportunities in it, and people are creating something new there all the time. On the other hand, it's just like in any other business, you can get commoditised pretty quickly. So you want to avoid the businesses that you think are likely to be commoditised in a hurry. Yeah. So a good example of that, Dell, is an interesting example. We like Dell at the moment. It's been beaten up pretty significantly, but its business model is changing. But just like Dell and HP, their old business, which was primarily selling desktops, is really dying. And people are moving from desktops to notebooks. So you have to be aware of how a business is changing, and you could buy something that's got a declining, revenue stream if it's replacing that with something new.
Yeah.